So in today's video, I'm going to be giving you a step-by-step guide on how to start investing. So if you are a brand new investor, then by the end of the video, you should know everything that you need in order to start investing. So how do I start investing? And what do I even invest into? And how do I build the foundation of my portfolio? We are going to talk about all of that in today's video. And the thing that you most likely have at your advantage is that you are a person who is 30 years old or younger than that. And that gives you a long time horizon. And that allows you to take on more risk. The only thing that I always hear from other investors is that they wish that they started investing sooner than what they did. So if you are a beginner at investing, then today's video is gonna be perfect for you. However, in case you're new to the channel, then my name is Casper, and here we strictly talk about investing and financial freedom. So if you really like investing and you want to retire early, well then press that subscribe button below. And also guys, please leave me a comment below the video and tell me whether you've started investing or not. And if you have, then for how long? It would be very interesting to hear that as well. So let's start by talking about why everyone is saying that they wish they started investing sooner than what they did. And that is simply because time is the most important factor when it comes to investing. I often hear new investors saying that I only have a few $100, and it really doesn't matter. You have to start building the habit of investing every single month. And it doesn't matter if you're putting $50 into the stock market every month, if you're putting $500 into the stock market every month, or even $1,000, you just have to start the habit of investing consistently every single month. That is the only thing that is important. But let me just show you an example of how investing a small sum of money every single month into the stock market can help you to reach your financial goals. We are going to take a look at this compound interest calculator here, which I also will leave a link to in the description below the video. But this calculator here is going to show you exactly how investing a certain amount of money every single month at an average return is going to generate you a lot of money over the long term. So in this example here, then let's say that we want to invest $500 into the stock market, and we want to be doing that every single month. And we want to be doing that for probably 30 years. Since we are pretty young, but then we do have a very long time horizon, as I said before. So let's say 30 years, and the S&P 500 index has on average increased by 9 to 10% for the last couple of decades. Therefore, I'm going to be setting the average annual return to 9%. And then let's just see how much money that we're going to have in 30 years from now by investing $500 every single month. So in 30 years, then we're basically going to be having more than $800,000 in our investment account. And that is absolutely insane to think about, that you can get that amount of money by only investing $500 per month. And when you look at the graph down here, well, then you can basically see that if you did invest, well, then you would get $824,000 in 30 years. However, if you did put those into a bank account, well, then you would only have $180,000. So there is basically a very big difference between investing and saving up your money. But let's make another example where instead of $500, then we put in $1,000 per month. And let's just see how much of a difference that this actually makes. So if we did put in $1,000 per month, then in only 30 years, we would have more than $1.6 million in our investment account. And that is a lot of money in only 30 years. And that is also why you have to start investing at a young age. It is going to be the best financial decision of your entire life. So let's say that by now you really want to start investing, but you have no idea how to start. Then the first step you need to take is to open a brokerage account. And to be honest, then it doesn't really matter which one you choose. They are all very similar. So find one where you like the interface and find one that is popular within your country and pick that one. Step number 2 is to open an account that fits you. And what I mean by fits you is that very often within different countries, then there is a certain account where you can get tax-free earnings, and that is the one that you should be focusing on. In the US, they have the Roth IRA, so no matter what amount you have within these accounts, then you basically don't have to pay any tax. And that should be your number one priority when it comes to opening an account, and that is to focus on those accounts where you get some tax advantages. Another example of a similar account could be a 401k, for example. And there are so many other accounts that does have some similar advantages to it. And personally, then I have something that is similar to the Roth IRA within my country. And then I have my taxable account as well. So step number 1 is going to be to find a brokerage. Step number 2 is going to be to open an account. And the third step is going to be to develop your investing strategy. You always want to have a strategy for whatever it is that you do, and that also includes investing. You have to find out what type of investor you are, and that does depend on your age, how much you have to invest with, your long-term goals, and so on. And every single investment that you make should match your strategy. If your investment strategy is geared towards being a passive investor that doesn't like taking on much risk, well then you probably shouldn't invest in small cap stocks. And if you are an investor who likes to take on risk, well then you should most likely invest in small cap stocks. I personally have a bit of a mixed strategy. I really like taking on risk, but at the same time, then I also like having a stable and reliable foundation for my portfolio. And that brings me straight into step number 4, which is going to be creating the core of your portfolio. When you have developed your strategy, then for the next couple of months, you should be investing into the core of your portfolio. And the core of your portfolio is something that you should be able to rely on and fall back on when times are tough, because those times will come. And for me personally, then my core holding and my foundation is the S&P 500 index, where I have more than 40% of my entire portfolio invested. It gives me a really good foundation, and it allows me to take on risk in other investments. And I'm basically investing into this one right here, the VOO. And by investing into this index here, well then you basically get a small fraction of 500 different companies within the US. And those 500 different companies, well, they are the 500 largest companies within the US based on market cap. So you basically get 500 different companies by only investing into this one ETF here. And that is going to give you a lot of diversification. And it is going to be the perfect solution for building the core of your portfolio. And the best way of building the foundation for your portfolio is simply by investing in ETFs. And ETFs can basically be seen as a basket of different stocks. And the next step, number 5, is going to be adding or reducing investment risk. And then again, then does this depend on your investment strategy and what type of investor you are? If you are the more risky investor, well then you probably want to be investing in some risky ETFs, some individual stocks and so on that does increase your overall investment risk. You can add more risk to your portfolio by only investing into ETFs. You can invest into ETFs that is following the tech market, that is following the semiconductor market, that is following the healthcare market. Whatever it is, then you can basically find an ETF for it. But you can of course also find individual stocks that does match your investment profile. And personally, then I have a bit of both within my portfolio. I have ETFs that is basically tracking small cap stocks, and then I do also have a bunch of individual holdings. And now we are at the last step, step number 6. And step number 6 is going to be to automate your investments. You want to make automatic deposits to your investment account so that you don't ever miss a month. You want to make it as easy as possible. And that is done by automating the whole thing. You can also automatically invest into stocks. So you could, for example, automatically deposit money into your brokerage account. And then those money would automatically be invested into, for example, the S&P 500 index. In this way, you don't physically have to do anything. All of the work is done for you, and you basically don't have to think about it. You can just watch your money grow over time. And that is simply the best way of doing it. And that is how you should be doing it if you are a beginner at investing. And that basically sums up my 6-step approach to investing for beginners. If I missed anything, then please let me know in the comments below. I hope that you liked today's video, and if you did, then don't forget to smash the like button below and subscribe to my channel for more weekly content just like this. See you guys in the next one.